Good morning, everyone, and welcome to July's edition of S&W Sessions. So today, the topic is going to be key tax considerations for M&A transactions. So my name is Alistair Shaw, and I'm a partner in our business tax services team here in London at S&W. I work extensively with fast-growing businesses. I support them as they seek to grow by acquisition, and then for many of those, we support them and lead them and support them on their way to a successful exit. I'm joined today by Sunil Parma, a director in our business tax team who focuses on VAT.
Hi, everyone.
So I've worked with Sunil for a number of years now. We worked together at EY, where Sunil was a director in their transaction tax team, again focusing solely on VAT matters. I'm also joined today by Peter Bull, a partner in our private client tax team. So Peter works very closely with Sunil and I and all members at S&W to take a holistic view on our privately owned businesses. It's important that we think about the owners and the corporate collectively, and Peter has a wealth of experience in this area. So in terms of the agenda for today, there's, I guess, three broad areas we're going to focus on. First of all, preparing for an exit or sale, then moving on to acquisitions, and then moving on to, I guess, some tax considerations to think of post-that acquisitions. And then, as always, with our S&W sessions, we have some key takeaways, and there'll also be plenty of time for questions for those who are participating in the call. After the event, as always as well, we'll then send out the recording and the slides so people can share it around or look at bits which are particularly relevant to them. So with that, I'm going to kick things off. I'm going to start by looking at preparing for an exit or sale, and specifically thinking about the structure of your business. So I think thinking about the structure for an exit, whether this is an entire exit or a piecemeal part of your business that you're looking to exit, this is relevant if you're a privately held business or a much larger listed corporate, in terms of you need to have your assets, the structure ready to sell the part of your business that you're looking to exit from. The example we've got on this first slide is a question I get asked quite often. It's focusing on probably more privately owned businesses, but I thought was relevant to share with you. So quite often the question I get asked is, we're a privately held business, we've got a number of different companies, does it make sense to group them? Should we group them under a holding company, or should we keep them separately? What's the benefits and which way should we go? Unfortunately, the simple answer is that there is no one answer that fits that question for everyone, and it's very dependent on what you're looking to do and how you might exit in the future. So if we look at the first example, where we've got the shareholder who owns Company A and Company B separately, this structure works really well where Company A and Company B are quite different, and actually any envisaged sale is likely to be of one of those parts and not both. Why that works well, it's very tax efficient for the shareholders to sell Company A or Company B in isolation at some point in time. It's then an individual, if the investors are individuals, it's an individual sale by that shareholder, so the funds go into the individual's hands and it's subject to capital gains tax at 20% or 10% if entrepreneurs relief is applicable. It also means the cash goes directly into the shareholder's hands. So that's the main benefit, really, of holding them separately. If you envisage, potentially one of the businesses being sold separately, it's much more tax efficient for the individual if they're looking to extract funds at that point in time. Under the second example, where we have a holding company, one of the main benefits of this structure is that what typically happens in my experience is you have one company which is maybe it's been established for a longer period of time, it's profitable, it's paying tax. Then the shareholders or the individual will start another company, Company B in this instance, and in the early days it's likely to be, or it may well be, loss-making. Under the first structure, where the shareholder holds them separately, there can be no sharing of the losses and profits across those two companies. So you pay tax in A, but you have losses that you're not using in B. Where you include this in a holding structure, then actually you can share those losses across the two companies from the point in time that they're brought together into a corporate group. So it's a big benefit if you're looking to share the losses. The major downside here for shareholders, however, is that if, let's say, company A is to be disposed of, that's a disposal by a holding company and not by the individuals. So one upside of that is that there's likely to be no tax on that sale as long as the holding company meets the requirements of an exemption called a substantial shareholding exemption. So you might sell company A for 10 million, 100 million, and you'd likely have no tax at the holdco level. The challenge is you've then got your 10 million or 100 million in the holding company, and if the shareholders wanted to get that out of the holding company and they weren't looking to sell company B or liquidate the structure, it's then quite tax inefficient to do that. You're then probably going to have to dividend those funds out of the holding company to the shareholders, which will be paying, potentially double or potentially 4 times as much tax compared to if you relied on entrepreneurs' relief in example A. So again, lots of things to think about, but the main point I'm trying to say here is actually think about your structure well in advance of any sort of exit. In terms of getting those structures into place, if you're looking to get a holding company above company A and company B, technically speaking, that will be a disposal for the shareholders, but there's some exemptions that can be applied from a tax perspective. So where you do a share-for-share exchange, you can typically get from structure A to structure B in a tax-efficient way. And what's helpful as well under this scenario, you can apply to get an advanced clearance from HMRC to get it agreed that this is not being done for tax reasons. Likewise, if you have a holding company and it holds company A and company B, you may be able to undertake what's referred to as a capital reduction demerger to separate out the two different businesses. Again, there'll need to be a commercial reason for doing that as opposed to purely a tax reason. But again, that's something that can be thought about later down the line. But clearly, the better answer, if you can try and structure this appropriately from day one, it makes more sense and will probably cost you less from an advisor's and lawyer's perspective. As everyone on the call will appreciate, I think tax planning and sort of how acceptable tax planning is for businesses has changed radically over the last 5, 10, 15 years. We've all seen across front pages of all the relevant sort of newspapers, articles about Starbucks and other large businesses who they've had reputational damage from undertaking what might be perceived as being aggressive tax planning. It may not be that aggressive, it's how it's perceived by people. And therefore, what the general advice is, and what we're seeing our clients do nowadays, which is very different to years gone by, is not implementing tax schemes. It's about paying a fair amount of tax and having a simple structure that works from a tax perspective. There's so much more anti-avoidance from a tax perspective that's been introduced in recent years. And I guess the relevance for mentioning this now when we're talking about preparing for an exit is that when larger businesses look to make acquisitions, they're very keen that those businesses, are paying the appropriate level of tax. But they don't want something through an acquisition which will cause them reputational damage. They don't want something from an acquisition that in the future is going to cost them potentially money to unwind. It's a hassle of then dealing with HMRC inquiries or taking matters through the courts. And we are seeing HMRC and the courts applying significant rigour on various tax schemes. So it can impact an exit, it can impact people's appetite, or it can mean that there's indemnities and warranties put on previous tax schemes. So as the seller of that business, you might be on the hook for a longer period going forward.
Thanks, Alistair. So we'll come on to talk about the DD process in a bit later. However, we thought at this stage it was important to highlight just how important it was to keep your tax affairs in good order right at the very start of the process during which you're considering an exit. Now, that can be very basic housekeeping, such as ensuring tax filings, VAT returns, and employment tax returns are up to date and correct. It can also be an opportunity to ensure that any issues that have not been looked at for a while are considered And, for example, a tax health check, which may consider some taxes which are not regularly reviewed, such as PAYE or VAT, are reviewed in detail before you actually get into a transactional process. This is also an opportunity to maximise any tax assets. This could not only have the benefit of improving any value of a transaction, for example, through any VAT reclaims that could have potentially been made, through any R&D claims that are not up to date, patent box, any EMI schemes or capital allowances, for example. There's a couple of main reasons why we recommend that this is looked at prior to you actually getting into a DD process. And they broadly cover two areas. One is practicalities. Anything around the time of a transaction can be extremely busy for the finance team or any other senior members of the business, covering other areas. Clearly, tax is just one area that needs to be considered during a transaction. Therefore, by ensuring that tax affairs of the company is up to date, this will save significant time under a pressurized situation of a transaction. Secondly, as I just mentioned, it's in terms of value. It's ensuring that there's not a higher tax cost on exit, and also ensuring that if anything is found during a DD process, this would involve additional costs in terms of potential warranties, indemnities for the current owners, as well as potential higher professional advisor fees during that transaction process. So I think the key takeaway in terms of getting your house in order is the timely preparation of a tax DD file and having all relevant information to hand in relation to the tax affairs of the company.
So in this next slide, we're just going to cover some of the hot topics or relevant issues that we pick up when we as advisors undertake tax due diligence. So I guess you might ask, why is this relevant when we're talking about preparing for an exit? Well, I mean, to put simply, these are sort of things that you should be thinking about when you're doing your preparation for an exit, so you can make sure these aren't things that you're going to lose value on at that exit point. So from a corporate tax perspective, transfer pricing. If you've got operations which are outside of the UK, then you should think about how, well, first of all, whether the transfer pricing rules apply to your business in the UK, but also to your overseas businesses. And this will be dependent on size in the UK, but overseas, there's quite often no de minimis. So think about transfer pricing. It's a hot topic which does come up for us from a corporate tax perspective. There's some new rules which came in from April this year called profit fragmentation rules. And in many ways, these look at offshoring of profits for businesses in the UK, which would be small enough not needing to think about the formal transfer pricing rule. So it's a new rule that's come in. Put very simplistically, it broadens out the transfer pricing legislation to much smaller businesses in the UK. So it's something you need to think about. I think the government's anticipation, it won't materially impact a number of businesses, but it's another compliance burden. It's another thing that businesses need to think about. Another thing that's topical is the new corporate criminal offence. This is around the facilitation of tax evasion. This is the new legislation which came in September 2017 and applies to all businesses. There's been a lot of new legislation around governance over recent years, and generally that's been aimed at larger businesses. And when I say larger, typically 200 million turnover and above. These new CTO rules apply to all businesses. And HMRC expect that you've undertaken some sort of risk assessment, and you've got procedures in place to prevent the facilitation by your business and associated persons of others. So it's not your tax evasion, it's the tax evasions of others that you're associated with. So quite far-reaching, and it's just demonstrating you've done enough to have reasonable procedures in place. Quite often when we look at DD, we'll look at some of the tax incentives claimed. So we spoke about tax planning before and about the need not to have tax schemes in place. What is still very much available and the government are very much supportive of is utilising available incentives and reliefs. So two which are very relevant, R&D tax credits and the patent box regime. So when we do a DD, we'll make sure that we think they're appropriate. We'll make sure that businesses haven't been overclaiming, so then there's a clawback potentially at the DD point in time. But also when we undertake our analysis here, if the potential investor is asking for our view, we'll obviously say, yes, it seems like they've been claimed appropriately, but actually we think the vendor has left value on the table. We think there's an additional R&D patent box claim that can be made, and therefore potentially that company is underselling the value of its business because of these assets, these tax assets they have in the business. Availability of losses post-deal is again something that we look at to think about whether losses in a company that's going to be acquired will be available post-deal. So those losses won't be available to the broader group. They'll only be available in that company. That, as I'm sure you're aware, there's some anti-avoidance provisions which they can be claimed in certain circumstances. So it's worth looking at that. It's also worth thinking about any earlier reorganisations or transactions that you've undertaken, making sure you've got the documentation and any advice put together and ready, so people, when they look at your business, they'll be wanting to understand what happened, what are the potential tax implications of that earlier transaction, reorganisation. So it's having that ready for the individuals. And then any deferred tax that you have on your books, making sure you can support those the deferred tax positions, particularly if they're assets, which may support the value of your business.
Thanks, Alistair. Moving on to VAT, when we're speaking to clients on VAT, especially over the last few months, the first thing on their mind is making tax digital. And I think that makes complete sense. The reason being, MTD is probably the most overreaching change in the VAT compliance process that we've seen since UK VAT came in. For a lot of VAT-registered businesses, MTD is now in place, and as we now beyond 30th of June, the first calendar VAT quarters will be submitting their VAT returns under MTD later this month or early in August. So I think from what we've seen so far, speaking to clients over the last 12 months on MTD, the vast majority of clients have to make some action in order to make their VAT compliance process compliant. And quite often that involves the purchase of some software to submit their VAT returns under an API from this year. So I think MTD should be high on the list when considering VAT. I've also listed some other areas of VAT which quite often come up on a DD basis. Now, the reverse charge, so when a UK VAT-registered business receives supplies from overseas suppliers on the input side, they are subject to reverse charge where VAT is self-accounted for. Quite often this is something that's not put in place by businesses, especially when the number of supplies received from overseas businesses is quite low or infrequent. Overseas VAT registrations for businesses in certain sectors, for example, any online sellers, are quite commonly overlooked, and this can often involve quite considerable penalties in certain European countries. In terms of the VAT liability of supplies and partial exemption, we quite often find that businesses who make predominantly exempt supplies sometimes miss charging VAT on supplies that are related to their core business. And likewise, businesses which make predominantly taxable supplies could possibly make some VAT-exempt supplies, for example, in relation to financial services, land and property transactions. Finally, in respect of land and property, businesses that have sublet property, again, as a non-core aspect of their business, quite often don't have the relevant options to tax in place. So this is something that's commonly picked up as part of a DD process. Moving on to employment taxes, there are some broad changes to the rules in terms of contractors coming in under IR35, and this is something we're doing a lot of work on and is very likely to be picked up in a DD process going forward. We often also find that short-term business visitors is something that are overlooked, and a lot of businesses don't regularly keep track of their employees and directors' business visitors both coming into the UK and outside of the UK. There are also termination payments. There's been some planned and recent changes to the tax and NIC treatment relating to termination payments. And again, we'd expect that this is something that would be looked at as part of a DD process. Finally, the business's eligibility of EMI schemes and other shared schemes is commonly picked up, and this is something that Peter will discuss in a bit more detail.
It's Alistair here. Just one further observation about the tax DD process. Such is the complexity of VAT and employment taxes. I think about my last few tax DDs in the last few months. A huge amount of focus on those areas. There's so much complexity. There's so much risk there. So a lot of the queries and issues will come out of VAT and employment taxes. In terms of the process itself and why you want to try and clear these matters up well in advance of a DD is that what will happen is we or any other sort of tax DD advisor will come along, we'll look at the potential risks, we'll then quantify the maximum risk, we'll then look at the penalties and the interest, so you get a worst case scenario in terms of the potential downside, and obviously that can potentially materially impact the value of the business from a tax perspective. Over to you, Peter.
Good. Thanks, Alistair. And that's a good segue into the income tax and employee shares issues that we often come up against in transactions. So what I wanted to do is just talk through some key aspects that come up as companies prepare to undertake a transaction, and things that come up in transactions that I thought would be helpful to relay to everyone on this call. So the tax legislation assumes that all shares that are held by directors, employees, are what are called employment related. That's regardless as to whether the individual is a founder or in relation to their history with the company. They're employment related in the eyes of HMRC. What that means is that some legislation that was brought in 2003 applies, and it's complicated legislation that was brought in at a time when 2003 there was a lot of tax planning going on, and a lot of it was focused around converting employment income into capital gains. So what we have is this legislation that is anti-avoidance focused, it's complicated, and it can have some unexpected consequences. And we're having to kind of apply that and look through the lens as to how HMRC would apply that as companies get ready for a transaction or when we're doing due diligence. So the things that can come up are issues where shares are acquired by employees at a price different to other parties, whether they are other employees or whether they are investors coming in at the same time. If they are coming in at a discount, if they're acquiring shares at a discount, that discount is likely to be subject to employment income tax. Now, that's either going to be a historic employment income tax charge from when they originally acquired the shares, or there is a risk if the shares that we're talking about are what are called restricted shares, and virtually all shares in private companies will be restricted shares. If they are restricted shares, that becomes of relevance to a transaction, someone investing in a business or someone realising value from a sale. That's because where shares are restricted, it means that as well as there being an historic employment income tax issue, there is also potentially an income tax issue that's going to be crystallised when they sell their shares. And that's going to be calculated because this is anti-avoidance legislation that we're dealing with. It has quite onerous implications, and it can have the consequence that if, say, shares were acquired at a discount of 20% when the values are pretty low, that 20% discount is essentially applied to the value that's realised when those shares are sold at any point in the future. So we've had situations where founders of fast growth companies have acquired shares at a discount or at nil price when the shares had value. They haven't entered into an election that can remove some of these issues, which I'll come on to. And what that means is that they could be subject to, in one recent case, 22% of their exit value was going to be subject to employment income tax and not capital gains tax. That's a big headache for the shareholder who's selling. It's going to significantly reduce their net tax proceeds, but it also potentially triggers an employer's national insurance charge for the company and therefore the buyer who's going to be taking that company on. That's where it becomes an issue in any due diligence process. So what can be done to deal with that? Well, if shares are being acquired at a discount, and really regardless of whether a share is being acquired at a discount or not, we would usually recommend that elections are entered into when shares are acquired, a Section 431 election, that they're entered into within 14 days of acquiring the shares. They don't need to be sent to the revenue, but they do need to be signed and completed. These elections can remove a host of tax issues on a transaction, and they will be asked for by an advisor doing tax due diligence into a company. And if you can present the Section 431 elections to the advisor doing the due diligence, they'll essentially be able to strike through a number of potential tax issues. So a takeaway from today is to go away and look at the share capital structure of your business. Who are the directors and employees in your company, and are there valid Section 431 elections in place for those acquisitions? If there aren't, engage someone to have a look and do a sense check review as to are there any issues in play that could come out as part of any transaction. If there are, better to deal with those potential issues now while it's under your control before any transaction process has started. When valuations are lower, you can apply greater discounts to the value of those employees' shares. So, Sunil mentioned the EMI. Moving on to the enterprise management incentive options and issues that come up in transactions. These are, if no one knows what an EMI option is, it's essentially the most tax-efficient way of giving an equity incentive to key employees. What they do is they enable an employee to realise, to exercise their option on sale, receive capital proceeds, and potentially pay 10% tax. That compares to up to 55% tax rate if someone has an unapproved option in the eyes of HMRC. So in any due diligence, the person coming in is going to want to check that they do meet the qualifying criteria for EMI. That will require the EMI to have been notified to the revenue within a period after it's granted. Practically, you don't receive in writing a notification from the revenue that you've told them that you've granted an option to an employee. You basically need to do a screen print of when it's notified online and use that as your evidence. You want to have an email from the revenue saying it's been accepted and notified. If the option or the company or the employee doesn't qualify for EMI, it means that there could be income tax and employer's national insurance crystallised when the option is exercised and when the shares are sold. That, again, brings an implication for the employer company, and therefore that can be an issue in any due diligence process. So better to check that through now, go back and make sure that in your tax DD file that's already evidenced. It's also an issue in that EMI options can crystallise corporate tax deductions in the company over which the option is granted. So that's a tax asset that the vendor shareholders would want to bring into account in any value when they're selling their company. So again, make sure that it qualifies, and that's something that will be checked. So moving on to quickly entrepreneurs relief. Founders of companies usually assume that they qualify for entrepreneurs relief and that no advice is needed. And until last October, I'd have tended to agree with them. The entrepreneurs relief was introduced about 11 years ago, 2008. It was worth £80,000 in tax savings at the time. It's now worth £1 million. And it's been fine-tuned over the years because the value has increased so much, and also in the tax landscape that we're working in. So in October 2018, we had the announcement that the rules were going to be further fine-tuned, and that they were updated again in December when they realised that what they were proposing wasn't really very workable. What we're now in a position is that for an individual to qualify for entrepreneurs relief, and it's worth £1 million to them in tax, they need to meet some key criteria throughout a 2-year period prior to a sale. You need to have a trading company or group. People will say, of course, it's a trading company. The revenue apply an 80-20 test to whether a company qualifies, and that depends on the group structure. It depends on the trading activities, whether there's any investment assets, and essentially if a substantial, which they take as 20% of amount of turnover, profit or assets or employee time is spent on non-trading activities, that could mean that there is no entrepreneurs relief available at all. The individual concerned has to be a director at a company's house or an employee. They need to have 5% of the shareholding in the company by reference to the nominal share capital and that shareholding needs to give them 5% of the voting rights in the company. And up until October last year, people would often structure the share capital so that people might have 5% of the nominal share capital, but perhaps, and 5% of the votes, but perhaps less than 5% of the economic value. The revenue didn't like that, and so they've changed the rules so that, in essence, an individual must also now be entitled to 5% of the sale proceeds on the sale of the ordinary share capital in the company. That brings in another question around the share structure and where the revenue view and how the revenue view ordinary share capital. The revenue can view certain forms of preference shares as ordinary share capital, and they've updated their guidance on this recently, and broadly, any preference shares other than cumulative fixed rate preference shares could be viewed as ordinary share capital. That could have a knock-on implication for people who think they qualify but may in fact not. The Entrepreneurs Relief rules are relaxed for EMI option holders who are so key employees. They don't need to meet the 5% test. All of the other tests need to be met, but that 5% test does not need to be met. In terms of key takeaways and recommendations based on recent experience, I should suggest having a health check review of your share capital structure. Are there any different share classes? Do you have any preference shares, shares with priority rights? Look at how that could affect people's eligibility for the relief. Could shares be transferred between spouses, for example, because each individual has a £10 million allowance, and we do see husbands and wives, they could both be directors of the group. They don't need to be paid if they are a director, so they could potentially take out 20 million at 10% tax, so saving them £1 million. Do trusts hold shares? It's difficult for trusts to qualify for entrepreneurs relief. The rules are very narrow. It is possible, but unless it's been structured to qualify, it may not. Trusts might be relevant, though, in terms of wider succession asset protection, so that's the question to ask. Check your group structures, the 80-20 point, and also just check that the gain is going to be subject to capital gains in the first place, and it isn't going to be subject to income tax and national insurance. So that's a quick run through of the Entrepreneurs Relief. I'll pass back now to talk about your structure and what you can expect in a DD process, sale process.
Thanks, Peter. So we're just going to move on to, we've spoken about preparing for an exit. Now it's about making an acquisition. So the first slide here just looks at whether that's going to be a share purchase or an asset purchase. So generally from experience, a seller will prefer a share purchase, and that's because if they're a corporate, as we touched on previously before, they can make that sale of shares in a tax-neutral way if they qualify substantial shareholding exemption. If they're an individual, as Peter's just been talking about, they're in CGT, and Entrepreneurs Relief may well be relevant. Quite often this is the favoured approach by the buyer, because the buyer will inherit the tax history of the target.
And in terms of VAT, the purchase of shares or the sale of shares is a VAT-exempt transaction, so no VAT would be chargeable. However, as we'll come on to a bit later when considering post-transaction considerations, the VAT recovery of transaction costs has been a contentious issue and must be considered in respect of a share purchase. Just finally, in terms of the tax history, it's much the same for VAT as is corporate tax. Generally, the VAT history will transfer over, and the buyer will be obligated to carry out the VAT obligations going forward. Just finally, in respect of stamp duty, subject to any exemptions or relief, stamp duty will be payable on the purchase of the shares.
So by contrast, an asset purchase then, so generally preferred by a purchaser because they're not then taking on the full tax and legal history of the company they would otherwise be acquiring, and potentially some tax upside as well in terms of if you're buying the trade and assets of the business and you're paying some amounts for some intangibles or goodwill, for example, there may well be a tax deduction you can then claim over the life of that intangible asset.
The VAT treatment of an asset purchase is slightly less clear-cut sometimes than a share purchase. The starting point is that the sale of assets is subject to UK VAT if it's a UK resident buyer. However, this is subject to whether the transfer qualifies as a TOGC or a transfer of going concern. There are certain conditions to be met, and if they are met, then the transfer would be VAT-free, so there'd be no VAT chargeable in this respect. Note that, as Alex mentioned, the tax history is generally left in the seller's entity, but there's one important movement away from this for a VAT perspective, and that's if the seller was required to make capital goods scheme adjustments as a result of their partial exemption position, then this obligation transfers to the buyer as a result of an asset transfer. Just finally, in respect of stamp duty, there's no stamp duty on the majority of the assets to be transferred. However, if there is land and property to be transferred over, there would be a potential SDLT charge on transfer, again, subject to any exemptions and reliefs.
Okay, so we're just going to quickly cover off the tax due diligence process. So I think the start of this process is looking at the scope of the review. So to put this into context, I think two of my current live deals, one of which is a smaller deal, it's probably about an 8 million acquisition, and they've gone for a high level tax due diligence scope. I'll come on to what that is in a minute. The other live deal I'm thinking about is approximately an 80 million acquisition, and because of the numbers, because of the size of the business, they've decided to go for a full scope review. So very broadly speaking, the difference between a high level tax DD and a full scope is very much you review all the underlying tax filings, the tax returns, the VAT returns, you ask lots of questions of management, you really get into the nuts and bolts to understand, try and qualify and quantify what the risks and tax exposures are. The high-level approach, as it suggests, it's more high-level. It's more, instead of going into the source documents, it's probably based on questionnaires and other questions of management. So quite different approaches. Obviously, that has a difference on the fees for the investor looking to undertake this process. I think one thing just to watch out for there is WI insurance. So this is warranty and indemnity insurance, which is becoming more and more prevalent where people are buying this on deals to protect themselves. You need to make sure that your W&I insurance provider is happy with the scope of work that's being agreed. So always worth checking that before you agree to that scope of work. Another thing to think about, and this can obviously add costs and complexity to the scope, is if you've just got a UK business, then you know, can be fairly straightforward. If you've got a business which has operations in a number of different territories, you know, clearly you need to think about those other territories. There may be transfer pricing, there may just be other overseas tax issues or risks that you could potentially become liable to. But again, you know, how much time do you want to spend on this? How much cost do you want to incur? It's down to each individual business and what your sense is for the risk and the materiality. But again, have a discussion with your advisor on that and come to what is, I guess, a pragmatic and sensible approach to cover not just the UK, but the potential global tax risks. In terms of the stages to a tax DD, once we've agreed scope, it's then a detailed information request which will go to the vendor. At this point in time, we'll be very keen to agree a strict timetable in terms of when that information will be provided back, so we then can undertake our review. And you know, there's always further questions. We'll get information back. There'll always be further inquiry that is required, discussions with management, etc. And then from that, we'll qualify and quantify any tax risks. And as I mentioned earlier in this presentation, that will include the potential tax risk, but it will also include any penalties which would be levied or could be levied by HMRC or the overseas tax authorities, and interest as well. So we've done all the work, we've got a deliverable, we then communicate those findings to management to make sure that management understand what work we've done, what are the risks we've identified, and what's the potential risk at stake to the company going forward. Then it's over to the company to consider, you know, the commercial impact and potentially negotiate in relation to any tax risks identified. The final segment we've got here is protection. So we then move on to the sale and purchase agreement. And at that point in time, it's important for us as tax professionals to review the warranties and indemnities in that SPA to ensure that our clients have appropriate coverage on any of the risks or potential risks that may have been identified, and try and sort of effectively exclude them from their ultimate cash flow risk going forward. So that's a little bit about acquisitions and about the DD process. We're just conscious of time, so we're just going to quickly whiz through some post-acquisition considerations that businesses should consider, and then after that we're going to open it up to questions.
Thanks, Alistair. So just very quickly, I referred to the VAT recovery of transaction costs earlier. Now, this has been a contentious issue with HMRC for a number of years now, and there's been a number of both UK and ECJ cases going through the courts. At a high level, the VAT recovery of any costs incurred on a transaction should be possible, but it's critical that the correct structure is put in place and that consideration is given to this before the acquisition completes. Now, it really is important to consider the structure prior to any transaction and as far in advance so the correct VAT structure can be put in place and the VAT recovered, for example, on legal, professional costs correctly on the transaction.
Okay, so losses in the group that's to be acquired. So as I mentioned briefly earlier, unfortunately those losses cannot then be shared across a broader new group once that company is acquired, but hopefully subject to anti-avoidance provisions, those losses will be available against the same trade of that company going forward, the one being acquired. There are some anti-avoidance provisions that need to be considered, so it's more understanding these rules and, to the extent possible, making sure you adhere to any conditions going forward so you're not losing those losses when that business is profitable. When you're part of a broader group, and as we mentioned much earlier on in the presentation around the structuring point, you can then share tax losses and other attributes of the group, something in capital allowances, for example, and different things that you can share around the group or make different claims so you can share different assets across the broader group from the point in time that that company joins a group. So it's just being mindful of that. Probably beneficial as well to have one advisor looking at the overall group, or at least if you've got two separate advisors that they're talking together and you're aware of the group as a whole, as opposed to just looking at two separate groups. Another thing, and to the extent relevant, transfer pricing. Again, you might have a transfer pricing policy which is relevant to your current group, but then you make an acquisition. It's applying your transfer pricing policy to that new group, or ensuring that the transfer pricing for the group acquired is appropriate, it's well documented, and that it is fit for purpose effectively. We quite often see groups who are quite acquisitive. I have one of my clients who would make 5 or 6 acquisitions every year. And what happens then? Well, after a number of years, you have a huge number of legal entities. It's pretty inefficient from a management perspective, preparing the different statutory accounts, tax returns, all the different transactions, and obviously costly as well. So again, at some point in time, and generally groups will do this, they quite often batch it, they'll look to simplify their group structure. They'll look to hive trade and assets up into group companies, and thereby look to minimise management time and cost on managing their group structure going forward. Again, it's just making sure that when you do that, it's undertaken in a tax-efficient way so you don't trigger any tax costs. And generally, that's possible. Again, it just needs a bit of consideration.
And I think just finally, in respect to post-acquisition considerations, it's worth updating any internal policies that may impact tax. I'm conscious that the compliance process for corporate tax may change in the enlarged group. The VAT registration position, for example, there may have been one VAT group and may now be separate registrations. That may change. So any documented procedures that are in place should be reviewed and ensure that they're still in line with the new wider group. And also, on the same page, any relevant HMRC agreements and obligations. For example, if the entity is under the senior accounting officer regime or corporate criminal offence regime, this should also be reviewed. What we often find is that a business may not have met the threshold to have any obligations under that, but post an acquisition, they may breach those thresholds and have new requirements that they didn't have before, which may need an agreement put in place with HMRC or certain filing obligations in respect of those. So it's worthwhile, much in the same way it is worth doing a tax health check pre-acquisition, it is also worth reviewing the new larger group post-acquisition to ensure that you are aware of the tax obligations of the group going forward.
So effectively done now. So just very quickly, we'll cover the key takeaways and then move on to questions. I can see we've got a few teed up already, but if there's any other questions, please do add to them. So key takeaways: prepare well ahead of a planned exit. Don't lose value on an exit because you haven't thought about tax and cleared up matters in advance. The second one: ensure that you appropriately scope any tax DD with specialist advisors if you're looking to make an acquisition, and then maximise the tax efficiencies post-deal. So make sure that you're sharing the tax attributes across that group. You're applying your policies, and you're not paying too much tax. And it is not just tax here; it's effectively simplifying the group. And if as ever, if you want to speak to us, we're always here to answer your questions and help you to the extent necessary. So with that, we're going to move on to questions. So one question here for Peter. So Peter, could you elaborate what the conditions are for the relaxation on entrepreneurs relief to be applicable when the greater than 5% test does not have to be met?
Yeah, thanks, Alistair. So the only people who don't need to have 5% are EMI option holders. So they are employees who have been granted an option. So they don't actually become a shareholder until they exercise their option. And it's only EMI option holders who can have less than 5% and still qualify for the entrepreneurs relief. Everyone else needs to have at least 5%. And the revenue applies strictly. We've had situations where people have had 4.999%, and they didn't realise that until they'd updated their share capital structure. They don't qualify, and that has a big impact on people. So something that's worth just flagging as well is we have situations where husbands and wives have shares between them, and one of them may have 7%, say, and the other may have 2%. Although you need to meet the qualifying criteria for 24 months, between husbands and wives, it's possible to transfer that 2% to the 7% shareholder. When they then sell their 9%, they will qualify for 10% tax on the full sale proceeds, even though they've only had that 2% shareholding potentially for a few weeks. So I hope that answers the question. Happy to pick it up separately.
There's also another question just come in about, is there much merit in doing a full scope DD if you are also taking out W&I insurance? Good question. A couple of immediate thoughts on my mind in respect to that one are, to actually claim under insurance policies, it can be quite a lengthy process to do that. Obviously, it's much better to know and to put as much in place as possible and have that detail before you need to make a claim in insurance. So I think my initial view on that is that, yes, I think there are certainly advantages of carrying out a full scope DD.
Yeah, I think that's right, and I think also it's we touched on this briefly in the presentation. It's certainly worth speaking to your insurance provider and just seeing if they're happy with the scope that's being agreed, and then it comes down to a commercial view of the business as to what risks they're happy to take if they feel a full scope is required. I know I speak at length at that scoping stage to really explain the differences, and then it's completely up to our client as to which route they want to go down.
And there's another question on VAT. Is the input VAT relating to costs associated with an acquisition, e.g. VAT on legal and advisory fees, is this VAT recoverable? The answer to that is yes, subject to the appropriate structuring. So when we're working on a transaction, we will generally ensure that the correct structure is put in place. For example, the costs are incurred by the right entity at the right time, the engagement letters are in with the right company, and therefore the VAT is recoverable. However, this is often something that is missed, especially in a transaction where there is quite a tight timeline, and there is sometimes very little you can do looking back if the correct structure is not put in place at the time of the transaction. So high level, that is recoverable, but it's important to get the right advice as early as possible in the process in order that the correct structure is in place.
So the next question is one for me and probably is a transfer pricing type question. The question is, what is the best way to integrate operations to realise strategic benefits of central cost savings while still being able to use acquired tax losses? So it's a really good question. So we mentioned before how losses in a company or group you acquired will not be available across the broader group. We also mentioned about transfer pricing applying to cross-border transactions. Now, transfer pricing does apply to UK transactions as well, and whilst HMRC do not generally focus on UK to UK transfer pricing, because ultimately you get to the same tax answer across the group, where they will potentially look to target companies on UK to UK charges is where they feel there might be a mismatch and actually too many profits are being put into a company that has losses which would otherwise be trapped. That said, commercially, under a new structure, you're absolutely right. The functions of that business will change, and that individual company with the losses will still be undertaking, may still be undertaking the same trade. It may still be able to utilise those brought forward losses, and I think it is fair to say that it have a different sort of charging mechanism and receive costs from a group company. So again, care needs to be taken, but absolutely, I think this would be the normal part of its trade. But we just need to be careful that we're not putting too many profits or costs into business, which then would trigger the attention of HMRC and would not be, I guess, on an arm's length basis.
Okay. There's another question coming in that I'll probably direct to Peter. What if one spouse has 2% and the other one has 10%? Can anything be done around entrepreneurs' relief?
So yes, it can. It's possible to transfer shares between spouses tax neutrally, and the individual acquiring that 2% could sell it, and provided they've individually qualified for entrepreneurs' relief for the 24-month period, which they would, if they've had 10%, they would qualify for entrepreneurs' relief in their own right on the sale of all of those shares, assuming that that's still below the 10 million threshold.
Okay, thanks, Peter. And one for you, potentially, Alistair. When should we consider undertaking a DD health check?
Okay, so I think the earlier the better, really, is a simple answer, but really you want to give yourself perhaps at least 6, 12 months, so we or your advisors can come in, or you can assess where potentially the risks are, and it then gives you time to mitigate any risks, to sort out any problems and get any issues agreed with HMRC. So you then, when you have your tax DD file ready for inspection, it's cleared up all these issues. And there's no better evidence than a bit of paper from HMRC which says, we agree with you on this point, or this matter's been resolved.
Definitely. And let's not forget as well that, yes, a DD health check or any kind of tax health check prior to an acquisition is helpful for a DD process. But what we often find, and especially on the VAT and potentially employment taxes side, is that there are also benefits to be found. There may be VAT claims or VAT input VAT that can be recovered that the business didn't know about, or potential efficiency improvements in the way the compliance process is put together. So, A, helpful for a transaction process, but B, there may be wider efficiencies that can help the business on a daily basis as a result of a tax health check.
Okay, a question here for Peter. Given 431 elections don't need to be filed with HMRC, Is there anything stopping a company retrospectively drafting 431 elections pre-sale?
That's a good question. So the answer is there's nothing stopping a company drafting them, but the problem is that if the revenue said, look, this wasn't signed by the employee and the company within 14 days, and how would they know that? I don't know. Then it wouldn't be valid. So it does, I think, sometimes they need to be reported depending on when the shares are acquired to the revenue through the annual employee share reporting process. But the point is that if it's after 14 days, then strictly it isn't not strictly, it isn't valid. But they do sometimes appear out of people's drawers. But the question is, that to be valid, they need to be signed within 14 days.
Okay, thanks, Peter.
Okay, conscious about time here, so I think we'll sort of call that a day. Lots of questions at the end there, so it's really good to have that engagement. I think we covered most of them, but our contact details are on here. Very, very happy to any of us on the team or anyone at S&W to pick up anything else at any point in the future. And we look forward to joining for the August S&W Sessions. I think the invitation will follow shortly. Thanks everyone for your time.